video, we will review the assets section of the balance sheet. Let's start with the current assets. These are assets that are expected to be turned into cash, sold, or consumed within 1 year or the operating cycle, whichever is longer. The operating cycle is the length of time between the purchase of inventory and the receipt of cash from accounts receivable. It includes the full cycle of purchasing, selling, and collecting. For most companies, operating cycle is much shorter than a year, so for short I will be omitting the operating cycle part of the definitions. Cash and cash equivalents are any currency, balances in bank accounts, and investments that mature within 90 days. Short-term investments are investments intended to be sold within the next 12 months. Receivables are monies expected to be received from customers in the next year. We frequently see it as net of any uncollectible amounts. Some companies show the full calculation on the body of the balance sheet. If this is the case, we will see the full amount of the receivables, everything that was sold on account, less the balance in the allowance for doubtful accounts, an amount representing balances that are estimated to be uncollectible. The result is the net amount, also known as net realizable value, and is the amount the company expects to actually collect. Inventories are merchandise held for sale to customers. The method of inventory valuation must be disclosed in the notes to the financial statements, such as FIFO, LIFO, average cost, lower of cost of market. All stages of inventory, raw materials, work in process, and finished goods should also be disclosed. Prepaid expenses are items that have been paid in advance and will be used within the next 12 months. Prepaid expenses include supplies, prepaid insurance, prepaid rent. Let's look at Walt Disney's current assets balances as of October 2nd, 2010. They had cash and cash equivalents for $2,722,000,000, receivables from customers of $5,784,000,000, inventories for $1,442,000,000. Television cost is an industry-specific account. This amount represents prepaid amounts for television rights that Disney will use within the next 12 months. This is an assumption that I made because of the fact that these dollars are included in the current assets section. The same can be applied to the deferred income taxes. This $1,018,000,000 amount represents prepaid taxes that Disney will apply to the current year tax bill. Non-current assets are assets not listed as current. The company will use these assets now and in the more distant future, longer than 12 months. Some long-lived assets last for decades. Long-term investments are another institution's stock or bonds or land, buildings, anything that the company purchased to resell for more money in the future. The key is that the company does not use these resources in their operations. They just hold them. Property, plant, and equipment are the fixed assets of a company. They are items that are acquired for use and not for resale. They have physical substance and they are depreciated, except for land. Intangible assets are resources that lack physical substance but provide economic value to a business. Examples include copyrights, patents, trademarks, goodwill. Goodwill arises when a company is purchased for more than it is worth. Why we would pay more? It's because it may have an extensive customers list or we love the location of its office. So, for example, if we purchase a company with net assets of $10,000, net assets is assets less liability, and we pay for this company $50,000, the goodwill will be the difference, or $40,000. $40,000 will constitute goodwill that will appear on our non-current asset section of the balance sheet. Other assets represent items that cannot be included in one of the other asset categories. Examples are prepaid expenses that will not be used in the next year, non-current receivables, and advances to suppliers. Some asset items could be listed in various categories depending on what management's intent is. Take land, for example. If land is being used for a plant site, it would be classified as property, plant, and equipment. If land is being held for sale, it will be classified as short-term investment. If it is being held for speculation long-term, it will be classified as long-term investment. This classification will change if the intent of management changes. Let's look at Disney's non-current assets. Film and television costs for 2010 add up to $4,773 million. These are film and television rights that will benefit Disney for a longer period of time. Investments that will be held long-term are $2,513 million. Disney's property, plant, and equipment includes parks, resorts, and other property that the company owns. Note how the cost is listed for $32,875 million. This is the acquisition cost. Remember the historical principle. Some of it may be purchased years ago and may have a much greater market value. The market value, however, is not factored in this total. The accumulated depreciation is $18,373 million and represents the used potential of these assets, or what dollar amount has been recognized as an expense. The book value is an informative figure. For Disney, that is $14,502 million and represents the leftover potential that Disney still has to use in the future. Land is also recorded at cost, but it does not depreciate, and on October 2nd is $1,124 million. Intangible assets such as trademark, trade name, jingle, patents is worth $5,081 million net of amortization. Amortization is allocation of utility from an asset to an expense, very similar to the depreciation concept, but applicable to intangible assets, hence the different name. Goodwill for Disney is $24,100 million. More information can be found in the notes accompanying the financial statements.